Statistics Canada released job numbers for April, and it was a bit of a mixed bag. So first, the good news. The unemployment rate stayed at 5.8%. That's the lowest level seen in 4 decades. And wages are on the rise, growing at the fastest rate in 6 years. The average hourly wage in April was just above $27. That's up 3.6% from a year earlier, the fastest pace of growth since 2012. The not so good news is that for just the second time in 2 years, Canada lost jobs, about 1,100 instead of the 20,000 job gain that economists had forecast. To explain what's going on here, we're joined by Frances Donald. She's senior economist at Manulife Asset Management. Nice to see you.
It's a pleasure.
1,100 jobs lost. That's basically a wash, right?
This is not something that's statistically significant, and what we really care about here is what's under the hood of these numbers.
Right.
And when I look at the underlying details, this is a Goldilocks report. It's not too hot, it's not too cold, it's just right for where the economy is right now. The jobs that were gained were full-time private sector jobs. We like seeing that. And critically, wages are up 3.3%. That's the number that matters more than any other.
Because they had been lagging. They were actually behind inflation for a while and then sticking with inflation. To see those go up, what does a wage inflation finally tell us about the state of the economy?
It's a critical number because it tells us not just the consumption power of households, which we need to drive the economy moving forward, but it tells us that the labor market might actually be tight. We might actually be in a situation where everybody that wants a job has a job. That's where wage inflation generally comes from. It's also very critical in this environment because it's going to help offset interest rate increases. We know that the debt burdens for many Canadians are going to start to rise, and seeing some wage inflation is going to help cover some of those bills.
Let's talk about the weaknesses, though, because, I mean, losing jobs is losing jobs. We've been adding full-time jobs and losing part-time jobs, which I think is healthy, but where are the weaknesses in this?
Well, a lost part-time job is still worse than no job lost at all, right? But the big story here is that the momentum is slowing in this economy, and we see it across every data point. So if you look at June of last year, we were averaging about 33,000 jobs gained per month. Now we're averaging closer to 17,000. So the car is slowing down, but it's certainly not stalling out. And this level of job growth, though, it's a little bit more consistent with the level of growth that we've seen in the economy, and it's probably going to be very helpful to the Bank of Canada. It's going to mean they don't have to rush to hike interest rates more quickly than they otherwise want to because the economy is overheating. It gives them a bit more flexibility.
On the monthly numbers, we have to always add this caveat. The monthly numbers are so volatile and there's crazy swings to them. On a year basis, though, if you look back a year, we've added 378,000 full-time jobs and lost 100,000 part-time positions. 278,000 jobs added. Blanket number. That's a pretty solid gain.
This is part of the Canada continuing to surprise to the upside story. This is an economy that has weathered the storm, that has come fully out of the energy crisis of 2014, the so-called recession of 2015, and continues to surprise economists with improvements in this labor market. And it's one of the reasons why we're seeing a central bank saying, you know what, this is an economy that no longer merits base bottom interest rates. This is a strong economy that can withstand a higher rate environment.
And does this, like, if we're slowing, does this tell us where we're going? Like, is it going to continue to slow? Is that your expectation? Or is it just going to sort of slow down, hit that lower level for a while and grind it?
Well, job growth is what economists would call a coincident indicator. So it's really good at telling us what's going on in the economy right now. Some might even call it a lagging indicator because we get it with a bit of a lag and it tells us more about what's happened in the past. But what I can tell you is the slowing momentum that we're seeing in the jobs data is very reflective of what's happening in the broader economy. Last year, in the first half of 2017, GDP was growing about 4%, and that's going to halve down to 2%. But I wouldn't worry too much. There's still very broad, solid growth here. We have 95% of industries growing above zero, 40% growing above 4%. This is broader but slower growth. I'm not too afraid of the economy right now.
We're going to talk to Philip Cross in a second here. He's going to tell us that, you know, these unemployment numbers are skewed and they're hard to read and they don't really give us the healthy look at the economy that we sometimes think it does. Your gig is jobs. I love you on Jobs Day because you're everywhere and you really have a handle on them. But they are only one indicator within a bunch that you look at to try to get the health of the economy.
Absolutely. In fact, I'm coming back to the Bank of Canada because they're really, as a markets-based economist, where I'm going at the end of every day. But the Bank of Canada has started implementing a new wage measure called the Wage Common, and they've decided we're going to take 4 wage indicators instead of 1 to give us a sense of what's truly happening. So the best way to look at jobs reports is always looking at averages, look at momentum over time, and don't take any jobs report just as a standalone. That's not going to really give you a good picture of what's happening in the economy.
Certainly not. Nice to see you. Thanks.
Nice to see you.
Francis Donald, Senior Economist at Manulife Asset Management.